Yo, what's up, guys? It's your boy Looney. Today, I want to break down something that most investors overlook, but it can completely change your long-term results. What happens if you miss just 5 of the best investing days each year? Spoiler, it's brutal. Let's get into it. But before we get into this video, quick shout out to the Discord. It is free to join, and they also offer a premium membership for $8 a month, and it gives you access to one-on-one coaching, trade callouts. I have an option selling course. I do giveaways and more. You can check it out. All the links to that are in the description. So here's the truth with the market is that markets don't go up in a straight line. Most of the yearly gains are packed into just a handful of really big days. If you sit out of the market and miss those days, your returns can get cut in half, sometimes even worse than that. There's actually a famous stat from JP Morgan that if you invested $10,000 into the S&P 500 in the early 2000s and stayed fully invested for 20 years, you would have over $60,000. But if you just missed the 10 best days of that time frame, not even every year, just total, your balance would be less than half. And that's the power of missing out. Now, imagine missing 5 good days every single year. You'd basically destroy your compounding and never catch up, even if the rest of the year was fine. But why does this happen? And the biggest up days usually come right after the ugliest down days. And if we go back to March 2020, this is actually before I even started invested. This is when COVID crashed the market. The next week had some of the biggest green days in history. If you sold out and waited for things to look safe, you'd miss the rocket ship back up. Let's actually look at the S&P 500 and take a look at that. And you'll notice it's just a blimp in the long-term time frame. So if you go back to 2020 in March, let's go a little bit further. So March of 2020, I'm actually struggling to even find it. Yeah, you could see this massive dip in March of 2020. It was down, I'm trying to get this exactly. It was down around 20%, which is pretty insane. And we look at it now, since then, it has only been up, or it's up 160%. Sure, there are some downturns, and there's one that's very recent that I'm going to show you and what I actually did to capitalize on that moment. But that's why timing the market is so hard to do. Most people pull out their money when they're scared, but those are exactly the moments when the best days sneak up. So what do I do instead? And it's very simple. I stay invested. This way I can't miss the day. I invest almost every single day. I'm doing recurring buys on some stocks and crypto, no matter what the market is doing. This way I never miss those days because I'm always in. I'm also selling options for steady income, covered calls, cash secured puts, some spreads. But even with those, I don't pull all my money out. My core stays in the market. The key is truly consistency. By keeping money in the market, you'll guarantee you'll capture those big days. And those days are what make compounding actually work. Also, having cash on the side for those pullbacks, being able to capitalize, is also really good for your long-term growth. And that's why I say in a lot of my videos, but I treat cash as its own position. Although it doesn't move much, especially with cash earning interest being so low with interest rates decreasing, having it there is super important because you never know if some black swan event is going to happen. And that is actually one of the best opportunities. If we go back to just this year, actually, let's go to the year to date chart because this gets pretty interesting. So obviously I was flat beginning of the year, slightly up. And then we saw in April, I was actually down 20%, 10,000. And most people would have been scared here and panicked. And a lot of people did. They ended up selling. They actually were selling off from March all the way to April, even some into May. But this is when I started buying or making big purchases. Let's actually scroll down to my leaps or this leap. So in May, I did see some recovery, so I decided to invest into a leap call, and you can see I'm already up 256%, and this is just 6 months away. Now, I'm still leaving this open for essentially another 6 months or a little bit more than that and seeing where this ends up, but I was able to capitalize on this due to having cash. If I was fully invested in the market, yes, I would have been able to fully recover. I'm up 26%, but having that cash to kind of double down absolutely helped in my overall position. Now, let's actually look at SoFi, because SoFi has been an interesting road, and same idea. Year to date, it struggled in April. Pretty much every stock struggled in April or March, somewhere around there, but really that Liberation Day. And that's when I decided to get into the stock. And sure, I could have got it for lower, under 10, but I was selling options. So I was acquiring premium no matter what. And I was able to acquire it at $11.29 is my average cost. I'm already up 130%. So despite this recent volatility with SoFi and just overall bad momentum, I'm still up significant. So I'm not even concerned of this movement. A lot of people are even deciding getting into SoFi at this point. Me and myself, I don't need to get into because of my position. I'm already up 130%. It takes up 20% of my portfolio. I do have some other leaps and some covered calls going and just overall different strategies. But you can see how important it is having that cash, being able to stay invested. Eventually, the stock market will recover, or in historic data, it has recovered. Now, it's hard to time these things. So the best way to do it is to not time it. And that's why you need to be invested constantly and just be constantly investing, building that growth, letting that growth compound. Don't be shaken out by the volatility, because that's truly when you want to strike, is that volatility. And a good thing that I like to look at with volatility is VIX. VIX basically goes over volatility, and it's a measure of it. And let's just go back to April or year to date and go back to April. You can see how much it spiked, basically saying there's a lot of volatility and a lot of fear in the market. And when there's a lot of fear in the market, that's when you want to be buying. Now, this sort of spike doesn't happen often. You can see here, if we want to go back to the best 10 days, would have been here in November, even a little bit in December, a little bit here. But you can see this volatility spike doesn't happen often, and especially doesn't happen above 30 too often. You can see here, it barely touches 30 randomly, but for the most part, it stays between that 15 and 20 mark. Right now, it's at 16. And if we go to the 5-year chart, it doesn't happen too often where volatility spikes. And if you miss out on these days, if you're shaken out, that could truly hurt your overall returns. But just to wrap up, here's the takeaway. Missing just 5 days or 5 good days a year can ruin your portfolio growth. Don't try to time the market, and don't panic sell. And don't sit in cash waiting for this moment, because you do need to be invested at some point. I did say that holding cash is important, but that doesn't mean hold only in cash. When I'm saying don't sit in cash, that means don't have all your money in cash. But overall, stay consistent, keep investing, and let compounding do the work. Because at the end of the day, wealth doesn't come from guessing. It comes from participating. Until next time, peace.